Taxation Law Questions Part 3. Explain the powers of Commissioner of Income Tax to reduce or waive penalties under the IT Act. The tax penalties are levied on the taxpayer for various defaults, and which can be majorly classified as default in payment of tax, failure to disclose appropriate income, failure to furnish the requisite information, and other transactional defaults. The penalties in some other cases can be as high as 300% of the tax leviable. In some cases, it can be per day charge for as many days as the default continues. Penalties can be imposed so as to avoid any further default. Section of the Income Tax Act under which the Principal Commissioner can exercise power to reduce tax penalty are Section 274A1, power to reduce or waive penalties imposed or impossible for default under Section 270A of Section 271 1C. Section 273A4, power to reduce or waive any penalty, stay or compound any proceeding for the penalty or recovery. Section 273AA, power to grant immunity from imposition of any penalty. It can be initiated by the principal commissioner or the commissioner of his own accord. The condition that needs to be satisfied to take relief under this section are: if it is established that the levy of the penalty will cause the taxpayer hardship, the taxpayer has offered full cooperation concerning any inquiry in relation to the assessment of any proceeding regarding recovery of an amount. The threshold limit of being granted a tax waiver can only happen if the penalty is imposed for the relevant year and if the aggregate penalty isn't exceeding rupees 1 lakh. What is meant by net wealth, and state the assets that are included in the net wealth of an assessee. Net wealth, also known as net worth, is the value of an individual or institution asset minus the value of liability. It is a measure of what's left after selling all assets and paying off all debts. Net wealth can be used to estimate how net worth could grow or decline over time. Net wealth may also refer to an investment and superannuation company that offers advice from individuals, experts, financial experts, or investors event. The assets that are not included in the net wealth of an assessee are as stated below. Personal belongings such as clothes and furniture are typically not included in net worth calculation because they are not sold during bankruptcy. Some of the other types of assets that are not typically included in net worth calculation are intangible assets. These are assets that cannot be held, such as goodwill, copyright, patent, trademark, and intellectual property. Human capital and social capital. These are not remarkable assets that are typically excluded from measurable wealth. Annual income. This is not considered as asset when calculating an asset. Thank you.